Hi there, Jim McCabe with the Knights of Columbus here. Thank you for joining us for our webinar this morning. Our subject today is 3 retirement strategies. Retirement can seem awfully complex. This is number 4 in a series of webinars for your benefit, and I appreciate you joining us. Today, I'm going to bring you into essentially a class where I'm training a newer agent. Arthur, Arthur Martinez has been with us for a little bit less than a year. And we find in training that understanding the different concepts of retirement planning can be one of the most difficult things for a newer agent to grasp. So today you're joining our class. Let's see, before we start, I'd just like to say, Arthur, you've done a great job as a newer agent. You've been with us for, as I said, for a little bit less than a year, and I'm very pleased with the growth that you've had. Interesting, when we talk about retirement strategies, you've been doing this for a little bit less than a year at this point, Arthur, and let me ask you this. How many times have you run into a retired family where the only source of income they have is Social Security?
It happens. It definitely happens. I run into it a few times, and it's a difficult situation.
And how are they living?
Not as well as they would hope.
And usually there's not enough money to go to pay all the bills, is there?
That's correct.
That's not a very pleasant way to end up in retirement. And I would urge all of you to make sure that you don't find yourself in that position. I've been doing this for 25 years, and I have seen hundreds of families that have only the income from Social Security, and they are in a desperate situation. Don't put yourself in that position. So let's talk about 3 retirement strategies. The first one is to make sure that you're putting something aside. I don't care if it's only 1% of your income. I don't care if all the best you can do is $100 a year. Get started with something, because when you get started, it creates a habit and you start thinking about what you need that money for. That's the first retirement strategy. And I find that the hardest part for a young person is to get started. So let's get started. Send money to the future. Number 2 is to beware of risk. I mean, have you seen situations? You probably haven't seen the same situations I have. I've seen people that are close to retirement and they've got all their money invested in the markets. And because they have all the money invested in the markets, usually it's because they have a mentality that markets only go up, the stock market only goes up. Over the long term, it does, but over the short term, it doesn't. I've seen far too many families have to go back to work because they lost 40 or 50% of their retirement savings due to market pressures. Don't find yourself in that position. Look at what you're doing frequently. Sit down with a professional. Get multiple opinions. It's important, and the only one that can do it is you. Number 3, as your income increases, especially as a young person, let's say you started off with that 1% that you're setting aside. As your income increases, increase what you're sending to the future. That's an easy way to make it happen without having a huge impact on your budget. But the fact of the matter is, once you have money in hand, we're going to find something to spend it on, aren't we?
It evaporates.
Indeed.
It evaporates.
Indeed. So those are the 3 key retirement strategies I wanted to discuss today. Now, I think one of the most difficult things to understand about retirement savings is tax qualifications. I say tax qualifications to a lot of my clients, and their eyes glass over because it's so confusing and so overwhelming. So let's go over that detail. I think we have a PowerPoint presentation to help us with that today. There it is. Yes, this PowerPoint presentation is income tax advantages. And essentially, it's a brief comparison of income of tax qualification strategies. So let's talk about that. Okay, so the income tax advantages that we want to compare are, first of all, a tax deduction. Now, a tax deduction is what, Arthur? It enables us to remove that income from taxation, right? So we get that tax deduction. It's surprising to me how many people put money into a tax qualified account to get that tax deduction, but then when they file their taxes, they don't qualify for it. And as a result, they wind up paying taxes twice on that money. The second thing is tax deferral. What is tax deferral, Arthur?
Tax deferral is when you set something up so that you're not paying the taxes now, you're deferring it into the future.
That's exactly right. The taxes are deferred into the future. So what happens is inside a tax deferred account, the money grows, but you don't pay taxes on the growth every single year. The third thing is tax-free income. Now, tax-free income can be quite exciting.
Yes.
And in fact, depending on what your tax bracket is, it becomes more exciting the more money you make. Wouldn't you agree?
I would agree.
Now, And then there's the IRS rules that apply to tax to retirement accounts. First, most common is the IRS penalty for early withdrawal before 59 and a half. Before 59 and a half, you'll pay a 10% penalty to the IRS for every dollar you take out of a tax qualified account. And then the other IRS penalty applies to age, it used to be age 70 and a half, now it's age 72. After age 72, you have required minimum distributions. And if you don't take them, if you don't take the required minimum distributions, the IRS assesses a penalty of 50% of what you should have taken. And by the way, this year in 2020, then required minimum distributions are waived. That is, nobody has to take a required minimum distribution this year unless they had already started taking RMDs in the prior year. And then finally is the death benefit. Now, death benefit is something that quite often people don't think about when it comes to retirement savings. But think about this for a minute, Arthur. What if you don't survive to retirement? What do you want that money to do?
I want that to take care of my family.
And you want to maximize what's going to be there to take care of your family, don't you?
That's correct.
That's exactly right. And I think that's the way most Catholic men feel about their families. Whether you're married or unmarried, whoever you have named as the beneficiary to your retirement accounts is going to receive those funds. But let's talk about how that's going to be structured. All right. So first, let's look at the most common tax qualification. It's an IRA. It works the same for 401ks and 403bs and TSAs and TSPs. The differences between those accounts have to do with how much money you can put in and what your income threshold needs to be in order to use it. But as far as tax advantages, they all work pretty much the same. So let's talk about this IRA. And with an IRA or a 401k or a 403b, you enjoy that tax deduction. In other words, you reduce that income from taxation. You also enjoy tax deferral, so there's no taxes due on the money as it grows. But it doesn't provide tax-free income. In fact, every dollar that comes out of one of these accounts is taxable as regular income. So if you pull it out as annual income, that's the income you're paying income taxes on as you are in retirement. If, God forbid, you have to take out a huge lump sum, let's say you want to pay for a roof repair or want to replace a car, you're going to pay taxes on all that money that comes out in a lump sum at 100% of it's going to be taxable. Then there's the IRS penalties. If you're under 59 and a half when you access these funds, with some exceptions, there's a 10% IRS penalty. If you're obligated to take required minimum distributions, then the penalty is 50%. As I said, 50% of what you should have taken. It becomes an IRS penalty. I think everybody likes Uncle Sam, but nobody likes his sister Iris. We want to pay the IRS as little as possible. Isn't that right?
That's correct.
And then finally, perhaps most significant is what happens on death. When you have an IRA or a 401k or a 403b, when you pass away, that money passes to your named beneficiary, and they have to pay taxes on it. 100% of it is taxable. If they receive it all in a lump sum, it is taxed as income. They can generally stretch it out over the course of 10 years to stretch out the tax liability as well. But the bottom line is 100% of it is taxable. Isn't that amazing?
That's amazing.
Well, next is a Roth IRA. Now, a Roth is a more new. It's not what I'm trying to say. It's a newer tax qualification. And the way that it works is just like this. You do not get a tax deduction when you contribute to a Roth 401k or anything like that. But you do continue to get tax deferral, and it produces tax-free income. Now, tax-free income is exciting, isn't it?
It sure is.
But you do still have that 10% IRS penalty, but no 50% IRS penalty. Why? Why do you think that is?
I believe it's because you paid those taxes in the beginning. The IRS already got their money from the beginning. You didn't get the tax deduction.
So the bottom line is, because it's not taxable, the IRS doesn't care when you take it out.
Correct.
Right? And likewise, they don't care if you hold on to it as a death benefit, because that death benefit will be income tax free to your heirs, to whoever your named beneficiary is. Next is just a CD or a savings account at the bank. No tax deduction, no tax deferral. You get a 1099 form at the end of every year for the interest growth in that account, and no tax-free income. But the good news is there's no IRS penalties at all. No 10% penalty, no 50% penalty, and it's taxed over the basis. What does basis mean to you, Arthur?
The basis to me, well, now that I'm an agent, I've learned this. I didn't know it before, but the basis is the part of the money that you put into it. The part that grows afterwards is not the basis. The growth is not the basis. It's what you originally put into it.
Okay, and that's well said. It's, let's use an example. Let's say that I take $10,000 and after-tax money and put it into a CD, okay? And it grows, let's say by the time I'm looking at it maturity, it's grown to $15,000. That would be nice, wouldn't it?
It would.
So it deposited 10,000, it's worth 15,000. How much of that is basis?
The 10,000 you put in originally.
Okay, so I'm not going to pay taxes on that 10,000 because it was after tax money, but I am going to pay taxes on the growth on the 5,000.
Correct.
Okay, very good. And the same thing is true when it's treated as a death benefit. When it goes to your beneficiaries, and you have a named beneficiary on these accounts as well, when it goes to that named beneficiary, then it's also going to be taxable to them over the basis, right?
Correct.
Next is a non-tax qualified annuity. Now, an annuity is a retirement account that's only provided by insurance companies because only insurance companies can write annuities. And the way that it works is just like this. There is no tax deduction. You do get tax deferral. There is no tax-free income except for the basis that you put the money that you put in. There is still an IRS penalty of 10% if you take the money out before 59 and a half, with some exceptions. I'm not going to go through the exceptions today. But there is no penalty over 72. And again, the death benefit in this case, you're taxed over the basis, just like you would be for taking it out for yourself.
Correct.
Right? And now let's transition to life insurance. Life insurance works very differently. And it has different purposes, but it's also a monetary growth instrument that can have aspects for your retirement planning. So no tax deduction when you pay for life insurance, but you do get tax deferral. And you can pull tax-free income from a life insurance policy, a permanent life insurance policy, as long as the policy stays in force. Let me say that again. As long as the life insurance stays in force, you can pull tax-free distributions from that. And that can be a lump sum or it can be periodic income. There are no IRS penalties. So if you take the money out before 59 and a half, the IRS doesn't care. And if you don't take distributions after 72, the IRS doesn't care. So there's no IRS impact here. But the death benefit, this is the key difference, I think, is income tax-free. So here's the thing. Usually I train our agents to ask a single question when they find money in a family. When you find a lump sum of money and it doesn't seem to be doing anything, the clarifying question we ask is what?
Is that money to live on or to leave on?
That's correct. And typically, if the money is to leave on, the best choice is to provide a tax-free death benefit via life insurance. If the money is to live on, that may not be the best choice. But the only way to ascertain that is to sit down with your agent and talk to them about it. And then finally, single premium life insurance. Single premium life insurance is a bit different than cash value life insurance. It is still cash value insurance, but it's called a modified endowment contract. An endowment is a retirement account. So as a result, there's some different treatment here. Again, no tax deduction, but tax deferral. No tax-free income. Even if you take a loan from the death benefit, it's still taxable over the basis. Taxable over the basis. So there is an IRS penalty because it's a retirement account of 10% if you access the funds early, but there is no IRS penalty after age 72. And then finally, it provides, and it's designed, its primary function is to provide a tax-free death benefit, for the people that you love. We use these for charitable contributions. We use these for funding buy-sell agreements. We use these for funding a variety of things. And that's the interesting thing about insurance, period, is it's really a tool that can accomplish so many different jobs. Every family is different. Every family needs a customized appraisal, a customized plan. And essentially, Arthur, that's what we do as we sit with our families, isn't it?
That is.
So you've been with us for a little bit less than a year. Go ahead and cut back to us, Mike. So you've been with us for a little bit less than a year. And how have you found this career? Has it been rewarding for you? Has it been frustrating? Has it been enjoyable?
It's been enjoyable. There are some frustrating moments. The learning curve is pretty good. But once you get a hold of it, the part that I really like is really getting to know our members, getting to know our people, and being able to make a difference in their lives. When you come out of somebody's house and you've made a real difference in their life, you can see the stress that you've taken off because they've been able to plan for their future. it's really, really rewarding.
Mhm.
And I've really enjoyed this.
It's amazing to me how many families I encounter that have never sat down with a professional to help them with their insurance or in retirement planning. You know, it's interesting, I think, to realize that as a member of the Knights of Columbus, you have access to professionals like Arthur and like the rest of our team to serve your family. We exist for no other reason than to serve your family. And I think that's significant. If you'd like to schedule an appointment with one of our agents, please call our office. The office number is 505-830-5770. Once again, 505-830-5770. Usually the lady that answers that phone is my wife, Eva. We've been married 43 years, and I have the pleasure of working with her every single day. Another way to reach out to an agent is to go to our website. Our website is NMKnights.com, MNKnights.com. And what you find there is you'll find a link to contact us, and it'll send an email right to my email box, and I'll respond very quickly, NMKnights.com. You're also going to find that that's our handle for Facebook and for YouTube. You'll find all of our YouTube recordings there. It's NM Knights on YouTube and on Facebook, and frankly on LinkedIn as well if you're looking for us there. So NM Knights or NMKnights.com. Until I see you again, take care and God bless.